So we ended Q1 at 38,300 crores, which is a net reduction of 6.3% on a year-on-year basis, broadly in line with the expectations that we had going into the quarter and which we had shared with you at the end of last quarter. The impact of currency further accentuated this from a dollar perspective, but from a rupee perspective, we are actually happy that we have ended the quarter on a year-on-year basis, marginally positive, with a growth of 0.4% in reported INR terms. From an operating margin perspective, we have been able to deliver 9,048 crores of operating profit, which is an operating margin of 23.6%. From a net margin perspective, we have ended the quarter at 7,000 crores, slightly more than 7,000 crores, which is a net margin of 18.3%. From a cash from operations perspective, once again, disciplined execution and the focus that the organization has been able to build is coming through and shining through in this number. We have ended with one of our highest cash conversion ratios, with cash from operations at close to 9,300 crores. We are ending the quarter with slightly more than 51,000 crores, and which keeps our overall capital return plan on track, despite the significant impact that we're seeing due to this pandemic. From a customer perspective, we are ending the quarter with 4 more customers at 48 in terms of the highest 100 million plus revenue band. Verticals, especially life sciences, healthcare, pharmaceuticals, etc., they have continued to maintain the growth trajectory and are growing still at close to mid-teens numbers, going at about 13.8%. Most other verticals have been impacted in some way or the other by the overall economic impact of the pandemic. Our largest vertical, banking and financial services and insurance, has had a 4.9% year-on-year decline in revenue. Within that, insurance continues to do better, while capital markets and then followed by banking, which has seen a short-term impact, whereas we believe that it will recover during the course of the second half of this year. Retail, travel and hospitality, and CPG has been the industry that has seen the maximum impact due to the pandemic. However, from a geography perspective, we see Europe as being most ahead on the recovery curve, and most of our customers in June are seeing good traction and good positive momentum, and we expect Europe to go back to its higher growth trajectory during the remaining course of the year. The United States has been among the most impacted, but also has been among the most resilient and adaptable in recovery and in planning for it. Overall, the sheer magnitude of the impact has been high, with year-on-year revenues reducing by 6.1% to 2.6 billion for the quarter. UK has been probably the most unfortunate in terms of having the twin impact of Brexit and COVID come together in this period, and that is showing through in our overall numbers. Our business in UK is down 8.5% on a year-on-year basis to 770 billion on a quarter. But I'm glad to report that in the market, we have outperformed everyone and have emerged as the second largest technology services provider in the UK market. Coming now to our overall innovation ecosystem, we are continued to make sure that our investments in our innovation ecosystem have continued. Our patent filings have gone up on a year-on-year basis by 642 patents filed to 5,324 new patents filed. More importantly, this has gone up by 108 new filed patents in Q1. Similarly, our patents granted is now at 1,471. And I'm happy to say that in Q1, we have got 140 new patents granted. And our focus on research and innovation continues. Our conversion of that into intellectual assets that are of value to our customers also continues. Our Igneo product and our bank's products have both had significant wins, with Igneo getting more than 8 new customers and banks getting close to 10 new customers in this quarter. We had spoken at the beginning of the quarter that looking at the uncertainty, we have frozen lateral hiring, but we will honor all outstanding hiring that we had issued. Milind spoke about the fact that we have been actively contacting all the 40,000 offers that we have made and engaging with them and preparing them to bring them on board during July onwards. The broad trajectory that we had laid out last quarter, I think we are still continuing to be on that. If you look at it from a vertical industry perspective, as I said, life sciences is continuing to be positive. BFSI, we believe, should start recovering starting from this quarter onwards. However, this is based on what we currently see, and we would like to wait for 1 or 2 quarters for it to stabilize. But we should see recovery in capital markets and parts of banking starting, especially European banking, starting from this quarter, and probably North American banking coming in by Q3. UK banking sector continues to be under pressure, and it is difficult to say when that will come in. Other industries like manufacturing, the Q3 or probably Q4 would be a more realistic sense of when manufacturing and the utilities would get back to where we dropped off from last quarter. The retail travel industry is a more complex one. We could break it into 3 parts. On one end is our exposure to airlines, travel, and hospitality, which the impact of it is likely to stay for quite some extended period of time, probably a year or more. Whereas the half of the remaining is what we call essential elements of retail, like groceries, and those are actually about a third of customers in our retail have had practically zero impact on a Q-on-Q basis and have been net positive. The remaining 1/3, we should see recovery towards later half of Q4 or Q1, which is essentially will go through a process of restructuring, and we will need to ride through that pain. But we believe that we should see recovery sometime in early next year. So overall, that's the color from an industry perspective. If you put it all together, when you think about the trajectory that we had laid out, we are quite confident that from rupee terms, we should be able to get back to the same year-on-year number by the time we get to Q3. So we'll be year-on-year flat in rupee terms by Q3 from where we see it today. On constant currency terms, we will come close to year-on-year flat by Q3. That's our current expectation. And by Q4, we should be able to get back to year-on-year flat on constant currency terms also.
The hallmark of this quarter is the institutionalizing of the secured borderless workspaces beyond the execution and delivery aspects. The deal wins and the overall orders that we booked during this quarter has been quite satisfactory and phenomenal given the external situation. And it has been quite broad-based. The communication, media, and information sciences delivered one of the largest deals. And then we have won deals in manufacturing. We have won deals in financial services, insurance, and platforms have also scored its own wins.
So as far as employee costs are concerned, our goal was to keep it at the same level rather than reducing it. And the second is we didn't go in with the compensation increases, which we normally do in the first quarter of every year. So it is with this, it is more to manage the inflation on the current base rather than to go and reduce it. And we believe that was the right thing to do in the circumstances. But on all other areas of cost, wherever discretionary spends were involved, we actually did a lot of management on that, and some amount of rationalization on the flex poolers or subcontractors. But overall, if you look at it from the actual revenue decline, which I talked about, almost 55% we were able to claw back in terms of many of these measures without the currency impact.
And we have published our 25 by 25 vision under the SBWS operating model, which envisages up to 25% of their time the employees will spend in the facilities, and at any point in time 25% of our workforce will be able to be in the office and contribute to 100% of being productive.
Our visibility into Q3 is better now than what it was when we first spoke about it in Q4. And I gave you a industry-wise color on where that recovery trajectory looks like. But in summary, we should be breaking at year-on-year positive in Q3 in INR terms, and getting close to it from constant currency terms, and probably breaking even on a year-on-year basis in constant currency by Q4. The recovery trajectory from here will be higher than or faster than the recovery trajectory that we had post the GFC. And that's primarily because the response to the crisis by various governments and institutions has been extremely coordinated and very large and very early, and that deployment has happened, and that should play out, and we should see the benefit of it coming. We have been steadily gaining market share in all the key markets that we operate in, and that is the true sense of what that pipeline is indicating. The unbilled revenue has gone down this quarter, but that is an indication of the strong financial conservative approach that Ramki has put in place, and which we spoke about. We, as I said, both the revenue, the margin, and the cash performance has been, despite a very supportive but a very conservative approach that we have taken to our overall financial management. And our conversations with our banking clients has been that they are well provided for, and they are now more than keen to actually engage in the technology transformation programs. This is across a wide spectrum. Cloud and cloud migration has been spoken about a lot, and there is even more willingness to experiment at scale with it in the US banking ecosystem, because today the current operating environment, and given the possibility that the situation might reoccur in the future, a cloud kind of an environment is a lot more resilient and reliable than a dedicated environment. So you're seeing a lot of traction on cloud. You're seeing a lot of traction on contactless customer engagement.
We expect, across the globe, we expect about 5% of our workforce coming to office by the end of this quarter. I think this is how the situation will evolve. Our 25 by 25 model will also basically get established as part of this process, and we will actually, this is our alignment with the new normal.